Hi everyone, welcome to today's class. Today we're going to see the question paper revision, okay? Asset liability management in banks. We're going to see only 2 marks today, okay? The first one is economic equity ratio. So what is economic equity ratio? Because the equity ratio, which means the investment leverage or a solvency ratio, okay? So this measures the amount of assets that are financed by the owners. Okay, the assets which are financed by the owners by comparing the total equity in the company to the total assets. Equity means which we have to pay, so which the investors invested. Okay, so economic equity means by comparing total equity the company of the total assets. Okay, so the equity ratio highlights two important financial concepts of a solvent and sustainable business. Okay, so the economic equity ratio is the equity is an investment leverage or a solvency ratio, so which is measure the amount of assets that are financed by the owners invested by comparing to total equity in the company and to the total assets in the company. Okay, so this means economic equity ratio. And then second one is what is residual maturity. So residual maturity means the period of a time, okay, until the debt payments fall due. Okay, in this guide, so it is recommended that short term remaining maturity of outstanding, which is external debt, okay, so be measured by adding the value of outstanding, so the short term external debt, so which are original maturity, to the value of outstanding long term external debt are a original maturity. So due to the paid in 1 year or less, this is also called a remaining maturity. Okay, and the next and third one is positive mismatch. So positive mismatch means uh, actually this is excess liquidity, okay, so which can be deployed in money market instruments, so by creating a new assets and investments. Okay, for example, okay, positive mismatch equal to maturing assets greater than maturing liability. Okay, so if comparing the maturing level is the main thing, okay, mismatch for mismatch maturing is the main thing. So positive mismatch means the maturing assets greater than the maturing liabilities, so which means cash inflow, so cash inflow greater than the cash outflow means liability. Okay, so that is equal to positive mismatch. And the next one is net interest margin. Oh, this is a measure of the difference between the interest income generated by banks, okay, so or other financial institutions, okay, and the amount of interest paid out to the lenders, for example, relative to the amount of their interest earning assets. So it is similar to the gross margin or a gross profit margin of non-financial companies. So it is usually expressed as a percentage. Okay, so net interest margin expressed as a percentage. So by this this is an asset. Okay, so formula for is what the financial institution earns on the loans in the period of other assets. Okay, so minus the interest paid on borrowed funds divided by average amount of the assets which is earned income in that time. So that is period of the average earning assets. Okay, for example, NIM is calculated as a percentage, we already know this. So this net interest income to the average interest earning assets during the specified period. Okay, so banks average interest earning assets which is $100. Okay, so in a year while it earned interest income, so the interest income was $6 and the paid interest expenses was $3. So the NIM is interest income minus interest expenses. Okay, income minus expenses, 6 minus 3 divided by securities, okay, long and investment securities, which means the interest earning assets, so that is equal to divided by $100, that is equal to 3%. So net interest margin is 3%. So then what do you mean by maturity gap analysis? So this maturity gap analysis compares the value of assets, so which is either mature or repriced within a given time interval to the value of the liabilities. So that is either mature or repriced. Okay, so that is during the same time of period. So this reprice means there is a potential to receive a new interest rate. So this method, while useful, is not a popular, as it once was due to the rise of new techniques in recent years. So newer techniques involving asset liability durations and the value at risk have largely replaced the maturity gap analysis. Next one, give the meaning of simulation. Okay, simulation means this asset liability management. Okay, so a technique of using operating account balances. It is to test various pricing models and run off the scenarios. Okay, so which used to determine the advance how the asset portfolio means loans. Okay, and liability portfolio means deposits. So loans and deposits are likely to perform under the different interest rate and pricing situations. So the purpose is to test the earning performance under the different interest rate hypothesis, which means simulation. Next one, VAR. VAR means nothing, value at risk. Okay, so it is a statistical because that measures or quantifies the level of financial risk within a firm, the portfolio or a position over a specific time frame. So this metric is most commonly used by investments and commercial banks, so which used to determine the extent and occurrence ratio of potential losses in their institutional portfolio. So which means the risk managers use VAR to measure and control the level of risk exposures, so which can only apply VAR calculations, so which used to specific positions. Okay, and the next one is a transaction exposure. So then transaction exposure means this is under risk. Okay, so risk of loss from a change or exchange rates, so during the course. Listen, this transaction exposure is a repeated question, so it is important. Okay, so the risk of loss from a change in exchange rates, so during the course of a business transaction. So which exposure is derived from a changes in foreign exchange rates between dates when a transaction is booked and when it is settled. Example, okay, a company in the United States, okay, which may sell a goods to the company in the United Kingdom, states to kingdom, to be paid in a pounds. So having a value that booking date was $100. So later the customer pays the company, the exchange rate has been changed. So it is for $95. Thus the foreign exchange rate change related to the transaction is created. So then it is 5,000 loss for the seller, because the transaction exposure is only applicable to the party transaction, so which has to pay receive funds in a different country. So the party only dealing in its home currency and is not subject to the translation exposure. So this can be significant risk when the currency is involved in an international transaction. Okay, and next one is a sensitivity analysis. So this sensitivity analysis means which used to determine how different value of independent variable affect the particular dependent variables. So which is under the given set of assumptions. Okay. In other words, the sensitivity analysis study how various sources of uncertainty in the mathematical models contribute to the model's overall uncertainty. So this technique is used within a specific boundaries that depend on one or more input variables. Then finally, Tier 1 capital under Basel norms. So which means this is one capital is a core measure of a bank financial strength from a regulator point of view. Okay, so which is composed to the core capital. So this consists primarily of a common stock, so which used to discover reserves or a retain earnings, but may also include non-redeemable, non-cumulative preferred stock. So which is based on Basel committee also observed that banks have been innovated instruments. Okay, so that is Tier 1 capital. So which is a conditions are limited to the maximum 15% of the total Tier 1 capital. So which is used to describe the capital adequacy of a bank and refers to the core capital that includes equity capital and disclosure reserves. So the equity capital is inclusive in instruments, so which cannot be redeemed of the option of the holder. Okay, and the next two more question. Okay, Excuse me. Okay. And the next one is liquidity risk. Okay, so this liquidity risk is the risk that a company or a bank, okay, which may be unable to meet the short term financial demands. So okay, which where this is usually occurs due to the inability to convert a security or a hard asset to the cash. Okay, so by this without a loss, they mean they are unable to convert a security or hard asset to cash without a loss of capital or a income in the process. So which by means the liquidity. Okay, liquidity risk generally arises when a business or individual with immediate cash needs, so which holds a valuable assets that it cannot trade or sell at a market value due to the lack of buyers or due to the an insufficient market. Okay, where it is difficult to bring buyers and sellers together. So for example, they consider $1,000. Okay, so with the home of no buyers, the home obviously has a value, but due to the market condition at the time, there may be no interest buyers. In a better economic times, when market conditions improve and demand increases, the house may sell for a well above the price. So however, due to the homeowner's need for a cash to meet near term financial demands, so the owner may unable to wait and have no other choice but to sell the house in an illiquid market, so which is in a low rate. And next one is a gap analysis. This is also important. This is repeated questions. Okay, so which is a comparison of actual performance with a potential and desired performance. So which is current state that desired future state. So an important aspects of gap analysis is identifying what needs to be done in a project. Okay, so the gap analysis can be used in many areas: sales, financial performances. So by this gap analysis is a method of assessing the differences in performance between a business information system or a software application to determine whether the business requirement are being met, and if not, what steps should be taken to ensure that are met successfully. So this gap refers to the space between where we are, means a present state, okay, and where we want to be, means a target state. So a gap analysis may also be referred to as a needs analysis, to needs assessment, or a need gap analysis. Next one is a stress test. Okay, so this test measures how healthy your heart is and how well it works during the physical stress. Some heart problems are easier to identify when your heart is working hard to pump the blood throughout your body. Okay, such as when you exercise. So this testing is a computer simulation technique, so which used to test in an institution and investment portfolios, which is against the possible future financial situations. So by such testing in a customarily used by the financial industry to help a gauge investment risk and adequacy of assets, as well as to help evaluate internal process and control. So in recent years, the regulators have also required financial institutions to carry out stress tests to ensure their capital holding and other assets are adequate. And next one is a scheme for sustaining structuring of stressed assets. Okay, so the Reserve Bank of India, which has issued guidelines, means scheme for sustainable structuring of stressed assets. Okay, S4EA. S4EA means S has 4, scheme sustainable structuring stressed, that is 4 A. Okay, S4A as a optional framework, so which is to manage a bad loans. Okay, so the scheme is the latest measure that takes taken RBI to tackle stressed assets. Under the scheme, the large ticket loans, so which are restructured by separating a sustainable loan from a unsustainable loan. So the main aim of S4A is strengthen the lender's ability to deal with the stressed assets and put real assets back on a track of entities which is facing genuine difficulties by providing an avenue for reworking financial structures. Excuse me. Okay. And next one is a stressed asset. We already seen this. This is important. Okay. Stress. Okay. We already seen the what is stress test, and it is stressed assets, which is repeated. So these are getting increased attention as the trends of deteriorating assets quality has emerged as a big economic risk for Indian banking sectors. So this assets is a powerful indicator of a health of banking systems. To understand the stress assets, we have to understand the NPA. Okay, non-performing assets. Okay, NPA and restructured assets. So this is because stressed assets equal to NPAs plus restructured loans plus written off assets. Written means written, WRITTN, okay, written off assets. So this NPA means non-performing assets. Restructured loans, okay, and next one is a written off assets. So these are stressed assets. And the next question is NIM. This also we already seen this. So this NIM is equal to investment returns minus interest expenses divided by average earning on assets. Okay, investment return divided by interest expenses divided by average earning on assets. So this NIM denotes the difference between interest income earned and interest paid. Okay, so earned minus paid divided by average earning on assets. And next one is why NIS is important. Why it is important means bank usually charge higher interest rate on the money. So it lends than interest it pays on deposits. So the difference between interest earned and paid is called a bank's net interest income. So the banks play a crucial role in mobilizing saving for a productive investment. So which is the form of a basic economic growth. Then the scenario analysis. Next one is a scenario analysis. So this means it is important to note that this is only as good as the inputs assumption may be by the analyst. Okay, so it is the process of estimating the expected value of portfolio after a given period of time. So which is assuming specific changes in a value of a portfolio securities or a key factors which take place such as change in interest rate. Scenario analysis are commonly used to estimate the changes to the portfolio value in responses to an unfavorable event. So which may be used to examine a theoretical worst case scenarios. Next one is time value of money. So it is idea that money that is available at the present time is worth more than the same amount in the future. So due to its potential earning capacity. So this core principle of finance holds that provided money, so which can earn the interest, and any amount is worth more than sooner it is received. So one of the most fundamental concepts in finance is that a money that has a time value attached to it. So in a simpler term, it would be safe to say that a dollar was worth more yesterday than today, because the dollar today is worth more than a dollar tomorrow. It may be increase or decrease. So it is worth. Time value of money. So based on this time value of money have a 5 variables based on the time value. Okay, present value, future value, and the number of periods, and interest rate, payment amount. Okay, and next one is commodity risk. So this refers to the uncertainties of futures. Okay, so this is uncertainty of future, this income which is caused by fluctuation in the prices of commodities. So these commodities which may in the prices of commodities, grains, metals, gas, electricity, which are etc. So a commodity enterprise needs to deal with the following kinds of risk. The risk are price risk, quantify or a volume risk, cost risk, political risk. According to price risk, so which is arising out of the adverse movement in these world prices, exchange rates, basis between a local and world prices, and related price area risk, which is usually rather minor impact. Okay, and next one is Next question, basis risk. One sec. And next, the next question is base rate. Okay, so which is mean is the minimum rate set by the Reserve Bank of India. So which is below which banks are not allowed to lend its customers. So the base rate is decided in order to enhance the transparency in a credit market and ensure, okay, so that bank pass to the lower cost of funds to their customers. So this loan pricing will be done by adding base rate and suitable spread depending on its credit risk premium. And next one, inclusive finance. So this is confused with the microfinance, so which is concerned with financial services and products which is destined to aid low income populations. So it is a word that is no one hand more global because it is regroups all the activities linked to the financial sectors. So but also more precisely because it clearly indicates its objectives to include the whole population, of course, in the economic system. Inclusive finance is the range of banking, products, financial services which made available to the poor populations. So these people are usually locked out of the conventional banking system due to their low income. So which is inclusive finance helps to finance their activities, save money, support their families and hedge against the risk of everyday life. Okay, and the next one is stressed assets. So we already seen this. This is a important. Okay, note this question. And second one, second Basel Accord. Second Basel Accord. So this is second Basel mean Basel 2. We already have one question like Basel 1. Okay, so this is Basel 2. So it is a set of international banking regulation to put forth by the Basel Committee on Bank Supervision. So which is leveled the international regulation field with the uniform rules, guidelines, Basel II expanded rules for a minimum capital requirements and they established under Basel 1. So the first international regulatory which occurred and provided the framework for regulatory overviews. So as well as the said disclosure requirement for assessment of capital adequacy of a banks. So the main difference between Basel 1 and Basel 2 is Basel 2 incorporate credit risk, okay, of assets. So which is held by the financial institutions to determine regulatory capital ratios. And next one is what is DRT? Okay, so DRT means Debt Recovery Tribunal were created in 1993. Okay, DRT means Debt Recovery Tribunal. Okay, so through an act to speed up cases of financial recovery by banks. So the bank and financial institutions, so which were experienced a lot of delays and difficulties in recovering the money lent and enforcement of the securities, which is used to pledge to them for the loans availed. So where the debt due from the borrower is more than 10 lakhs. So the case could be filled in DRT. The working of the tribunal is similar to the court. So the borrower who is aggrieved by the order to the DRT, which can approach a appellate tribunal, because such an appeal should be made within a 45 days. Okay, so the receiving of the orders of DRT, debt recovery tribunals. So he has to deposit 75% of the amount which is due from us to the bank and financial institutions. So while filing his appeal, the appealing tribunal has got the powers to reduce the way this amount. And next one is microfinance. So this microfinance, also called microcredit, so which is a type of banking service provided to unemployed or a low income individual, to the groups who otherwise would have no other access to the financial services. So while institutions are participating in the area of microfinance, which most often provide lending microloans, can range from as small as $100 to a largest $25,000. So many banks offer additional services, so such as checking, savings account, as well as micro insurance products, and some even provide financial and business education. And goal of microfinance is to ultimately give unimprovised people an opportunity to become self-sufficient. Okay. Next one, explain ARCIL. So AR means Asset Reconstruction Company, is specialized in institutions. Okay. So this ARCIL, mainly known as Asset Reconstruction. Asset Reconstruction Company of India. Okay. Limited. So which is promoted by ICICI and IBDA, State Bank of India. Okay, so this is specialized financial institution that buys the NPA or a bad asset from a banks and financial institutions and helps the banks to clean up their balance sheets. Okay, and next one is a default risk. So it is a chance that bond issuer, okay, the issuer, one who issued the bonds, so will not make a required coupon payment or a principal repayment to the bond holders. So the difficult risk is the chance that the company or individual will be unable to make the required payments or a debt obligation. So the lenders are invested or exposed to difficult risk in virtually all forms of credit extension. So a higher level of risk leads to a higher required return in a return. So a higher interest rate. Next one is credit syndication. So this is services rendered by the merchant bankers. So in the form of organizing and procuring financial facilities from financial institutions, banks, other lending agencies. So this means financing arranged on behalf of the client of a meeting both fixed and capital as well as working capital requirements. So which is known as syndication service. Next one is currency swaps. So this is also called cross currency swap. So which is off balance sheet transaction. Okay, so when two parties exchange the principal and interest in the different countries, so the parties involved in currency swap are generally financial institutions that either act on their own as an agent for an non-financial corporations. By this, in finance, the currency swap, also known as cross currency swap, so which is legal contract between two parties to exchange two currencies at a later date, so but at a predetermined exchange rate. So usually these global banks operate as a facilitator or a middleman in the currency swap deals, but they can also be counterparties in currency swaps as well as the hedge against their global exposure. And next one is CBIL. Okay, So this CBIL means Credit Information Bureau, so which is India Limited. Okay, so this is the company engaged in maintaining the records of all credit related activities of a companies as well as the individuals, so which is including credit cards, loans, like that. So this CIBL, okay, score is 3-digit number summary of your credit history. So score is derived using the credit history found in the CIBIL report, so which is also called CIR, the credit information report. So this CIR is an individual's credit payment across loans types and credit institutions over the period of a time. And next one is economic value added theory, so which is a measure of a performance of a company, so which focus more on a wealth or a value creation for the shareholders rather than just the accounting profits, so which is finding real profits which a firm has earned, all the costs are deducted from the revenues and made. Similarly, the cost of using capital should be also deducted, whether it is debt or equity. Okay, so by the CIBIL, so this economic value added is equal to net adjusted operating profit after the tax. Okay, NOPAT, net operating profit after the tax minus cost of capital. So this NOPAT, net operating profit after tax, means it stands for net operating profit, and that is a profit before charging any cost or a capital employed. Okay, and the next question is basis risk. Okay, so which is a financial risk that is offsetting investment in a hedging means from reducing, okay, strategy will not experience price changes in entirely opposite direction from each other, so which is defined as a inherent risk a trader, so which is takes the when hedging a position by taking a contrary position in derivative of the assets, so such as a futures contracts. Basis risk which is accepted in an attempt to hedge away price risk. Next one is net position. So this is a difference between total open long receivables and open short payables. Receivable payables difference in a given assets, so which is security, foreign exchange currency, commodity, and held by an individual. So this also refers to the amount of assets held by a person, firm, financial institution, as well as the ownership status of a person, institution, investments. Next one is money market instrument. So this is a short-term financing instrument aiming to increase the financial liquidity of a business. So the main characteristics of these kinds of securities is that way which can convert it to cash with ease, thereby the preserving cash requirements of an investor. So the money market and its instruments are usually traded over the counter. So therefore, this cannot be done by standalone individual investors themselves. It has to be done through certified brokers or a money market mutual funds. Okay. And next one is credit quality. What do you understand by the term credit quality? So this is one of the principal criteria for judging an investment quality of a bond. So bond of mutual funds. As the term, the credit quality informs investors of a bond and the bond portfolio credit worthiness or a risk of default. So a company or a security's credit quality, so which may also be known as its bond rating. Then the credit rating is quantified assessment of a credit worthiness of a borrower in general terms or with respect to a particular debt or a financial obligation. So this rating can be assigned to any entity that seeks to borrow money, an individual, corporation, state or a provincial authority or sovereign government. Next one is credit default swaps. So this means it is a financial derivative or a contract which allows an investor to swap or offset his credit risk, so with that of another investor. For example, if a lender is worried that a borrower is going to default on the loan, the lender could use CDs to offset a swap that risk. So to swap the risk of default, the lender buys CDs from another investor who agrees to reimburse the lender in the case of borrower default. Okay, so which require an ongoing premium payments to maintain the contract, which is like an insurance policy. So the credit default swap is a most common form of credit derivative and which may be involve municipal bonds, emerging markets bonds, mortgage backed securities, corporate bonds. And next one is a demat account. See, this is the main dematerialized. Okay, so this is a short form of dematerialized account. So which is an account hold financial securities, equity, debt. Okay, in an electronic form. So this account are maintained by two depository. One is National Security Deposit Limited, and second one is Central Depositories Limited. So the depository participants such as a bank acts as an intermediary between the investor and depository. Mainly demat means this is an electronic form, financial securities. So this account number is quoted for all the transactions. So enable electronic settlement of traders to take place. Okay, so by this transfers on purchase of securities which can be initiated, the purchase on a sales of securities on the dematerialized account are automatically made once the transaction are confirmed and completed. And next question is NII, net interest income, we already seen, and NIM, net interest margin. This is a third time asking question. They are asking. Okay, NIM. So please go through the question paper. If you don't know, let me clear you. Feel free to ask me. Okay. Thank you all. Take care.